And here's a look at where markets ended the week and the month after NVIDIA, the world's most valuable company, posted a double beat on earnings and revenue, but fell short on expectations for data center revenue. We also got the second read of second quarter GDP, beating estimates, now at 3.3%. And the Federal Reserve's preferred measure of inflation in line with expectations, up 2%. 0.2% month over month and 2.6% annually. Joining me now is Lonski Group founder John Lonski. So, John, we did get a lot of data this week, in particular Friday's PCE. That's the number that's really going to shape Fed policy. Or is it? Do you think it's going to be the employment picture?
It is helpful. We are seeing a moderate containment, if you like, of PCE, price index inflation. It's not going through the roof. That's the important thing. And so this brings attention to this week's upcoming report on the labor market, specifically how many jobs were created in the month of August. And, the market is betting that it's still going to be on the low side, maybe no more than 75,000. Well, that tells me that if jobs creation for the 3 months ended August is 75 grand or less, then chances are the Fed will be cutting rates by at least 0.25 percentage point come September 17th. And that's what the market is looking for.
And the market also, once it digested not just the GDP, but also the PCE price index. I mean, we're just not hitting that 2% inflation target for the Fed. But now, based on what we've heard from Jay Powell, that's kind of not the mover it was. I mean, the market reacted slightly, but not to the tone that we thought we were going to get. It really wasn't the market moving piece of data. It could have been.
Well, I think Jay Powell and the rest of the Federal Reserve, they're fairly confident that this is only going to be a transitory pickup by price inflation. Hate to say it, but that's their sense. And the thing is that with tariffs, we are going to get a one-time boost to prices, but that's important, only one time. We're not going to have a situation arise where tariffs by themselves are going to be capable of leading to a long-lived rise by price inflation. Most believe that price inflation, because of tariffs, will peak by early 2026. Meanwhile, we do have the slowing of the labor market, weakening of the labor market, and that should help to contain price inflation. In fact, it wouldn't be surprising if the slowdown in jobs growth leads to a slowdown in consumer spending growth that does the job of making it very difficult for companies to continue to hike prices.
Well, and we just heard from the Labor Secretary as she tours across the country that those people want to get to work, and that's obviously the messaging that she's said she was putting out there. But let's talk about the stock market because look, the month of August was strong. I mean, so far the stock market has done very well. We had new records. What do you think we go from here, though, with the markets? I mean, once, the Labor Day holiday is over, everybody comes back to their desks and gets back to work. What do you expect?
Well, I think, the biggest risk in the stock market might be its own success over this past summer. My goodness, stocks are richly priced. You have above average valuation risk if you're buying into the market today. Would I sell now? No. Would I rush to put a lot of new money into this market? No, I wouldn't do that either. I would take a cautious approach. We now have the market value of U.S. common equity is about 205% of GDP. We've never seen that before. For purposes of comparison, during Trump's first presidency, the market value of equity averaged 135% of GDP. You're paying a lot of money now for each dollar of prospective expected corporate earnings.
John Lonski, it's great to see you as always.
Okay, thank you, Cheryl.